I'm sorry, the previous lesson has been a bit too long, but sometimes you can't help it. Actually, it doesn't feel right to break the flow of a lesson and split it into parts. But not to worry, this one is going to be quite small. You see, in the previous two lessons, we have learnt about long and short futures with stop loss. That means we went long on future with a stop loss, and we also learned about going short on the future, that means selling the future with a stop loss. We had taken the example of Nifty, that is an Indian index, but that could be applied to any index, or for that matter, any stock or any asset like currencies or commodities or whatever you are trading in. All right, the same strategy is applicable for all type of assets and all type of indices. Now the problem with placing stop loss order is that the stop loss remains valid for the day only. It's only for that day. Every day a fresh stop loss order has to be placed, because by the closing of the exchange that order would automatically expire. You see? But what will happen if next day the price opens with a huge gap against your desired direction? For example, if you have gone long, you have bought a futures, you keep it overnight, your stop loss would expire at the closing of the exchange, and next day morning when you get up, the exchange or the Nifty opens with a huge gap down. You will suffer a huge loss. In that case, before you can even place a fresh stop loss order in the morning, if the opening itself is with a huge gap down or gap up, whatever, if it is against your desired direction, then you will suffer a huge loss. Therefore, this strategy of applying a stop loss order is good only for intraday trades, only if you have to square off your trade on the same day. So, what can we do if we have to take an overnight position with a larger time perspective? Say you want to take a position, you either want to buy a future or sell a future and wait till the expiry of the contract, which may be probably 1 month away. What do you do in such cases? See, you can formulate any number of strategies using a combination of futures and options. But the most simple strategy, if you are bullish or if your analysis or your perspective tells you that the price is going to increase in the future, then you can go long futures and long put. It is also called as hedging long futures with put option. What it primarily means is that you buy a futures contract and simultaneously buy a put option of the same expiry date. The futures you are buying because your perspective is that the price is going to increase, but just in case the price goes other way, then the put option which you are buying will protect you. Or if your perspective is bearish or your analysis tells you that the price is going to fall in the future, in the near future or before expiry, if you feel that the price is going to reduce, in that case what you can do is you can short futures with long call. It is also called as hedging short futures with call options. Primarily what you do here is that you sell futures contract and simultaneously buy call option of the same expiry. That means you are selling futures because you want the price to go down, but just in case the price goes up, then the call which you have purchased, the call option, that will save you. But how do we do it? We shall see in the next lesson. All right.